With the bigger units, like what you were managing before, 150 units, it makes sense to have an on-site property maintenance person. When you have smaller communities like 10 units or 30 some units, it does not make sense economically to hire a maintenance person full time. So how do you handle your property maintenance? Okay, great. So how many units do you own right now?
Currently, with our multifamily portfolio, 44 units. We just closed on our second project a couple months ago and looking to grow from there. It goes back to fundamental that my dad taught me is if the project or the property makes sense from the day you buy it, that's all that matters.
So how did you find the deal? Let's talk about deal sourcing. So how did you find it?
Where I've focused on, and it's been broker relationships.
Hello there, and welcome to another episode of Bigger Life Podcast, where we dive into minds of real estate professionals who are building bigger lives through real estate. I'm your host, Ray Bansal, and today we got an incredible guest with us, Hayden Duer. Hayden Duer is co-founder of Duer Eurocama Group, a real estate investment focused company building well through multifamily. So they are based out of Southern California. Hey, welcome, Hayden. How are you doing today?
Doing great. How are you?
I'm doing just fine. So thanks for joining the show. So Hayden, I understand that you were into property management before you got into investing yourself, right?
Yes. Yeah. I was in property management. Started as a maintenance guy and worked my way up to becoming a property manager of large apartment buildings of about 150 to 250 units.
Awesome. So were you working for somebody, or it was your own company, or?
I was working for a company, a couple of different companies. One was in my hometown up in Northern California. Then when I moved to Southern California, I worked for a national company, property management company.
National property management company. And how was that life?
It was good. It was a means to an end. So basically how I got into it was I have a family portfolio that I manage. The portfolio, and my dad and my grandpa invested in real estate. And so right after college, I asked my dad what I need to do to get into investing into real estate. And he said, start from the ground up. So that's what I did. I started as a maintenance guy, worked into leasing, then became an assistant manager, then a manager, and learned the ins and outs of the operations side. I don't have millions and millions of dollars in cash. So wanted to learn one facet of the business while I grew the other facets.
And how long did it take you to do that?
Took me about 7 years. So about 5 years, sorry. So from about 2017 to 2022, 23 is really when I stopped and then started my own business.
Okay. And what are you doing into your business now? So you're investing into commercial real estate, right? Into multifamily?
Multifamily, yes. Yeah, we do value add multifamily throughout the United States, a few different markets in the United States.
Okay, great. So how many units do you own right now?
Currently, with our multifamily portfolio, 44 units. We just closed on our second project a couple months ago and looking to grow from there.
Isn't like 2023 is a time frame when, from the crossroads of real estate industry standpoint, especially commercial real estate, everything's kind of on the bad side, right? Your labor cost is up, rents are coming down, your mortgage interest rates are high. And the prices now, 2025, the prices are slightly different, but 2023 prices were still high, right? So how did you manage to work that deal from where everything is kind of on the bad side of the real estate to turn it around to your favor?
Yeah, goes back to a fundamental that my dad taught me is if the project or the property makes sense from the day you buy it, that's all that matters. As long as you're cash flowing, if the value of the project went, you bought something at $1 million and then a day later it dropped to $0. If you're cash flowing from day one, what does the value of the project even matter? And so that's kind of the fundamental that I've stuck to, and kind of how you get through those situations.
Sure. So would you like to share some numbers, like what was your purchase price, how many units it is, and what kind of return you got? Was it a value add, or what did you have to do to make it work?
Sure. So the first project we did, it was a 10-unit project. It was a value add. 6 of the units were already renovated. So we went in, renovated the remaining 4 units, did some curb appeal updates, and we finished that in several months, about six to 9 months. Finished that project as we removed the tenants and then renovated the units. That one is currently stabilized and cash flowing really well. So for that one, right now we're cash flowing somewhere between 8.5% to 10% per month. Prior to, or when we purchased it, we were cash flowing about 3.5%, 4%. And what we really liked about the deal is that if we were 60% occupied, we were still cash flowing. That's kind of a standard that we like to buy at around, well, on the smaller deals, about 60%, because there's a lot of things can go wrong quickly. But the bigger deals is a little bit a little bit strict.
Did you say 8 to 10% per month, or is it annualized?
It's annualized. Yeah. Sorry. Yeah. Annualized 8 to 10%.
So how did you find the deal? Let's talk about deal sourcing. So how did you find it?
Where I've focused on, and it's been broker relationships. I've been talking to brokers for about 2.5 years now. How I first got in and jumped in is I called a million brokers. Well, not a million brokers. I called a few brokers a million times and just built relationships with them. Flew out to the markets. This project, I'm in Southern California. This first project was in Tucson, Arizona. So we flew out to Tucson a couple of times, met with the brokers. And it's tough when you're first getting started to figure out, hey, with these brokers, can you send me some quality deals? Well, if they don't know that you can execute, they're not necessarily going to give you the best deals, because they don't, they give those to the investors that are going to execute. So you got to figure out your way to get in and execute when your number's called. So made a bunch of phone calls similar to our deal in Kansas City, Missouri. We did the same thing. Called a few brokers and continued to reach out to them, stayed at top of mind, letting them know we were ready to buy and executed when we could.
Sure. Let's talk numbers. So what was your purchase price on that?
The first project, $1.34 million for the 10 units.
1.34. And how did you structure it from a deal funding standpoint?
So it was seller financed for 3 years, which allowed us, or opened us up some cash flow. So it's interest only 6% for 3 years, and so the remaining 40% is a 60% loan to value. So we raised 40%, and then we also raised the renovation. So it was about $100,000, a little over $100,000 in renovation, and then the equity we raised about $540,000 for the remaining 40% from friends and family and our network.
So what's the annual cash flow of this deal now?
We closed about a year ago. So now for the next 4 to 6 years, we should be cash flowing anywhere from 8.5% to about 12%. We do plan to refinance because we'll need to. So once we do that, the cash flow will dip down just a bit. But we still plan to be around that 8% plus.
Yeah, plus the refinance would be good for your investors, right? Get that money back or invest into another deal, whatever you think ahead.
Yeah.
So what about the lessons learned from your first deal that you applied to your second deal?
Yeah. From a project management standpoint, just being on top of our construction teams, having weekly, or if not more, weekly meetings or more, making sure that we're on budget, we're on time, sticking to that budget and that time, and then also getting contracts for renovations in writing before you get started. Those are a couple of things on the project standpoint. And then the property standpoint, for me, coming from a property management background, the operations and the asset management was really, it was a smooth transition for me. And staying on top of that and thinking about the project from a property manager's lens has really helped our operations and has helped our full function of the project. And it's really where we've lacked in certain areas that we've learned a ton. We've made up for tenfold in that regard.
Let's talk about your second deal. So you want to talk numbers on that deal? So how did you find it?
Yeah. So that one's another broker relationship. It was an off-market deal. And it had been on market been marketed by the broker to their investors for several months. and probably 6 or so months. And we had originally offered significantly lower than they were asking, and they just basically said, no, that's not what we're looking for. And after several months, the broker came back to us out of the blue. Originally, I didn't like the deal because of the price point, and so I, offered what we could, and we said that's where we're at, and stuck to it. They came back to us and said, "Hey, we want to entertain your offer. Can you come up just a bit?" So we looked at it. There was a couple things that needed to be done, and we ended up coming to an agreement. So that the purchase price was $2.05 million. So just over $2 million for 34 units, just north of downtown Kansas City.
And how much was it occupied at the time?
It was at 100% occupied. So there's 33 units, and then there's a laundry room that we're now going to convert into. Once towards the end of the project, we'll convert into a unit.
What was the original price? Because it was marked higher, and then you offered. And what was your offer? So let's walk this deal through for our listeners, right?
Yeah. So it was originally they were originally asking 2.375. 2.375. We offered 1.95. So we offered just under $400,000 less than the asking price. And that was maybe a month in from them marketing it, and they said no. They got into contract once or twice, didn't work due to timing and a couple other things, but it wasn't property related. So that's what gave us a little more confidence going into to contract. So then we negotiated back and forth and landed just about 2.05.
So since you're remote, so it's kind of hard to go and check the properties every time,
right?
Especially in the early stages when you're discussing deals and numbers. So how did you pencil the deal in without having your foot on the ground kind of thing?
Yeah, it's a good question. So while I was talking to brokers and calling constantly, I was also building a team and kind of building my all-star team, I guess, so to speak, for that particular market. So for Tucson, we found property managers, we found construction team, and different vendors. Kansas City, the same thing. So we set up our market 3 to 6 months before we even dove in to many deals. We made sure that those were the markets that we wanted to buy in based on a few different criteria, and then we really dove in. So the teams there are the best for that project, in our opinion. We really like the teams that we have: our property managers, our vendors, and construction teams in both markets now. So that gave us the confidence to be able to buy in a market that we're a 2.5 hour flight away from. And I also, my family portfolio, I have experience. We have projects in Arizona and Texas. So I have experience managing from out of state. I'm in Southern California. We also own projects in Northern California. So I'm very comfortable with out of state or out of area management. And so that transitioned really nicely as well.
Like, you're in Southern California. How did you pick these markets? I mean, what were the factors in deciding upon that I'm going to go into Arizona and Kansas City?
Yeah, it's a good question. So for us and where our network and investors could execute, we decided that those were the best markets for us. It's very cash flow heavy in those markets, not necessarily as cyclical. So you're not going to see these huge boom and busts that you've seen in, for example, if you're in Tucson, that you've seen in Phoenix, or you've seen in San Diego or LA. So for us, we felt comfortable, and going back to the fundamental that I had mentioned in the first place, buying when, and you can cash flow day one, it was the most important. So cash flow heavy, also with, some positive market demographics. So there was in Kansas City specifically over the last 5+ years, there's been rent growth north of 3% in the market. In this specific submarket, there's been rent growth of north of 5% over the last 5+ years. So we really liked that aspect. Population growth is another factor that we look at. Big companies coming in. Kansas City has a lot of growth and a lot of big companies coming in there. And it's not a very tapped market in the sense that these big these big companies are not necessarily going in and buying in these markets. So we don't have as much competition in Tucson or Kansas City that we would in, say, a Dallas or a Phoenix. Not to say we wouldn't buy there, but that's why we bought in.
Point is that there are still opportunities in the market. It's matter of fact to do some analysis to figure out which markets are better suited for your investment goals. But if you make that determination and do that analysis, there are deals that will still, in today's market with high interest rates, will still make sense. So let's go into the numbers. So with this deal, what were you cash flowing when you bought it? Because it was already like 100% occupied, right?
Mm-hmm. Yeah. So this one, we were cash flowing about 4.5% for where it stood. And our rents were at 6. They're all studios, which is typically, we don't necessarily like to buy all of one floor plan unless they're bigger floor plans. We typically like to buy a bulk of, or when we're buying a project, we typically like to buy 2-bedroom, 3-bedroom apartments. But this one, given the price that we got and the deal that we got, we really liked it. So it's all studios. They were all non-renovated. The exterior needed needed a facelift, and so the current rents when we bought them were at $656 per month. So with that, we were cash flowing about a little over 4.5% when we first started. Then now we've gone in and we've started to renovate. We've had 2 units move out, so we've renovated those units, and the replacement rents went from $656 to $850 for the renovated units.
And how much did you have to spend to get that rent appreciation?
Yeah, so that one, so we went in, we did a full cosmetic renovation, and then we also added washers and dryers. We've added hot water heaters, so we did quite a bit to the unit, and we spent just under $12,000 doing all of that for the first 2 units.
12,000, so 6,000 each or 12,000 each?
12,000 total, 12,000 each. So about just under 12,000.
So that's a good return on investment. So each $12,000 is bringing you about $200 rent difference.
Right, and we should land closer to a $10,000 as we get going. But these first
as you scale up,
and we're trying to figure out. Currently, we're figuring out what we can get for what we've rent wise for what we've done to the unit. So we have a plan in place, but if things are more efficient, which we're starting to dial in our efficiency on this particular project, we'll land around $10,000.
So let's break this $12,000 down, right? So you put in new washer and dryer or just the hookup?
Yep. We had to add the hookups and add the ventilation for the stackable washer and dryer. And then we put new flooring in, new paint, countertops, all new appliances. And the appliances were a little expensive just because they were smaller appliances. For whatever reason, the smaller appliances probably because
standard are cheaper than these smaller ones. Yeah, I've noticed that as well. Anytime I have to buy those smaller ones, it's hard to find, and B, they're like at least 20 to 30% more expensive.
Exactly. Yep. Yeah. That's what we're finding as well. Yeah, and we're just doing just a cosmetic, renovation to the remainder. So, and then adding in hot water heater.
So prior to this, it did not have the hot water heater, or
it did, but they were old and they were the small 19-gallon hot water heaters. And the biggest complaint from our tenants when we were in due diligence was hot water. And we want to make sure that our tenants are comfortable. We want to make sure that we are, they stay as long as possible, and we can keep the tenants as long as we can. So that was a big factor, determining factor for us. Hey, we need to make sure that we go in and have a budget for replacing all the hot water heaters. So we gave them a bigger hot water heater, and the units that we've done it to, the tenants have been very grateful for it.
Awesome. Now, when you were doing your due diligence, right?
Mm-hmm.
So what were tenant complaints? So what are the things that you normally look for apart from the condition of the property? What are the soft things that you're looking at?
Yeah. So for us, when we're going through due diligence, we want to make sure that the property fits what it, ideally we do this before due diligence, and we did for this project as well, but making sure that the project fits what we've been told and things check out. So not only from a a nuts and bolts standpoint from the property, but also from, like I just mentioned, tenants being happy. If tenants aren't happy, that's one area that we can go in and we can improve operations, and we can justify increasing rents for doing nothing, because we can go in, fix up the property. We can also fix up the curb appeal and a couple little things that make tenants happy, make them want to stay, and then increase the rents from there. But additionally, we look at major issues. So plumbing is the first thing, electrical, and then also any foundational issues, just the major things that people look at, but the big ticket items that we make sure that we check off before we even dive into the units.
So what did you do? Did you talk to the tenants yourself, or because normally you basically have an inspection team inspecting stuff out, or?
We go in and my partner and I inspect. Through the inspection, we go in and get eyes on every single unit, all units of every one that we purchase. So we get a good feel of one, that's a value add thing that, didn't necessarily increase the value of the property. It was kind of deferred maintenance, but it's one thing that we talked about in negotiations. It's one thing that we identified that could help these tenants. So that's a big reason why we go in and get visuals on each of these units. Additionally, if we see leaks or we see things that are common in multiple units, we start to question, and we start to talk to the seller about it and talk to the brokers about it. Hey, these things weren't really disclosed. We saw these visually, or we heard this from the tenant, such and such. And so that's really why we like to go into each and every unit and not skip any, so that we know exactly what we're buying.
Sure. And when this happened, when you were doing your diligence, how much of a cost reduction were you able to negotiate with the seller at that point of time?
We went into the project doing a little bit of background before we got into contract. So from there, it was probably $50,000 to $75,000 before we went into contract, based on the deferred maintenance and a few different issues. And then we went into the inspections while we were in contract. And there were a lot of maintenance, just simple things like maintenance work orders that weren't being taken care of. So we made sure that all of the maintenance work orders that had been taken, or that had been in queue and not taken care of, we made sure that they were taken care of before we closed. So that was another probably around 10,000 or so that in kind of deferred things that weren't taken care of, that they did before we closed. And it sounds simple. It sounds kind of, ticky tacky, but at the time that, it was just customer kind of complaints that crept up, and we saw a lot of consistency in some of these issues. So we made sure that they took care of those before we closed.
And did you log into the property management system to see all those pending items, or how did you find those?
We asked for every work order for the last 24 months.
Nice.
So we when we asked, both the broker and the property manager kind of just dropped their jaw, like, you want every work order for the last 24 months? And I said, yes, I'm going to analyze every single one of them, make sure that everything's been done properly.
Yeah. And how was the data? So were they using some kind of a system, or?
Yeah, it was just kind of a standard. I don't know exactly which one. It might have been Appfolio, but they were just using a standard property management software. So it was pretty easy for them to pull. It was just, they were like, that's a little excessive. But
yeah, they were like, man, what is it going to do about all this stuff? 24 months.
Right.
Yeah, it makes sense. Think about it differently, right? So now with the bigger units, like what you were managing before, 150 units, it makes sense to have an on-site property maintenance person to manage those units. Yep. But when you have smaller communities like 10 units or 30-some units, it does not make sense economically to hire a maintenance person full-time. So how do you handle your property maintenance for these mid-sized units?
We have two things. So one, we have our property management company that they also have a maintenance team that takes care of these. So priority work orders or emergency work orders are taken care of right away. We make sure that within 24 to 48 hours that our maintenance teams are responding, or our property managers are responding to work orders. And if it's something small like the toilet paper rack fell off. We wait until we get a bulk of work orders for them to go out, because our property management office probably about 15 minutes away from the property. So they go out to the property maybe, if there's nothing wrong with the property, nothing going on, they go out to the property maybe once every 10 to 14 days. So in the meantime, if there's something going on, there's a bulk of work orders, then they'll take care of all of those smaller work orders. Whereas if you're in a bigger project, it's taken care of. These smaller issues are taken care of within 48 hours, and the emergencies are taken care of in an instant. And then the second thing is we also have a property technology company that we work with that helps us with a lot of foresight for our units. It's called Onsite Analytics. So it's basically what it is we have this chip. It's about the size of a quarter that we put on kind of the door sill, and you tap your phone to it, and it gives you the records of all of the appliances, everything in the unit, and all the work orders that have been taken or that happened in the unit. So we're able to reduce a lot of future headaches, a lot of issues with this. So we can see, 3 months ago we did X, Y, and Z to the HVAC system. Now we can diagnose exactly what's going on, or we can diagnose things. We can check things off quicker and save a lot of money that way. And then additionally, they give us, that company, Onsite Analytics, gives us a lot of data, and we were actually able to use it to determine if we wanted to do stackable washers and dryers versus the all-in-one washers and dryers, to see where our costs are going to save. And over 34, 55, 110 units, you could really save if you're saving $150 overall for the next 2 years per unit, or 2 to 5 years per unit. You can see where that starts to add up in these projects. So
let's talk about this on-site analytics thing. So can you help explain, so how does this work? So what's the life cycle of it? So you basically install a chip into your door sill.
Yeah, it's just a adhesive that you just stick onto the door sill. You don't have to put it on the door sill. You could put it on, the back of your refrigerator, wherever, so that the maintenance team comes in and they tap their phone to it. It pops up the records, and it is specific per unit. So it'll pop up the records of that specific unit. It doesn't have to be multifamily. It can be used in single family. It can be used in industrial, any type of unit. So it taps up the maintenance work orders and the work history. It gives all of the information for warranties, everything under the sun for that particular unit. And it also they send reports of, facts about your particular appliances that you're using, life expectancy, how you can save long term for those particular appliances.
How did it help you analyze that? Take that example for washer dryer that you said, which one to put, because you haven't put that just yet, right?
We put in the stackable washer and dryer in our first 2 units. So it helped us there because we were going to put in the all-in-one, because there was not going to be, we didn't have to do any plumbing. We could have just hooked it up to the lines on the kitchen sink, and it didn't need any venting. So the installation was going to be significantly cheaper, maybe $1,500 to $2,000 cheaper per unit. However, they sent us this report that is generated based on all the data that they've collected. It generated a report that said, hey, it's going to be cheaper to get these, or the stackable washers and dryers, specifically this model, because you'll save over the next 5 to 7 years, which is going to be the hold time of your property. You're going to save over the next 5 to 7 years on maintenance costs, on replacement costs, based on all the data we've collected and all of the, just general data about these units.
So this is the value that you're adding to this podcast. So what is this company called?
Onsite Analytics.
So let's talk about cost, right? So in real estate, especially multifamily, so we got some costs. So what did you factor in, and how do you analyze it? So I know your units are 100% occupied, but do you factor in some kind of a vacancy factor to it?
Yes. Yeah. So in commercial lending, they typically factor in 10% of vacancy on their underwriting. And that's kind of a base that's for these smaller units. And that's a base vacancy and credit loss that they are factoring in. For us, we do that same thing minimally. We start at 10% and go from there. And that way we make sure that it's not only vacancy, it is credit loss. So if you're able to beat, for us, we do that each year. So minimum 10% vacancy annually. So if you can beat that 10% on vacancy, but if you lose, you have some leeway or some leverage. So if you lose, say, if you're not getting the rents that you want, say rents dip in the market, you're able to have that little cushion. So that's why we factor in minimum 10% at a starting point for each year. On top of that, we add in a vacancy for the renovations. So the first 2 years, our vacancy for year one is about 20% that we factored in, and year two is about 16, 17%. And we did that based on how many units that we want to rent or that we want to renovate and how quickly we want to do it.
Sure. And what are some of the things like repair factor, capital factor, property management? So what are the percentages that you were looking at as part of your underwriting?
Yeah. So, and that came to light. We talked to property management companies prior to getting into contract over the last, 6 months to a year before we got into contract on kind of what to expect. We, based on the market and their data, they gave us about $4,000 per unit per year in operating expenses, and that's everything included. So we, as kind of a general rule of thumb, so we went in with our underwriting and we factored in 8% for property management because it's a smaller property. Typically, it's anywhere from 3 to 10% based on the size of the property and the scale. But we factored in 8%. We knew that it was going to be 6% plus leasing fees and advertising fees, things like that. Then we added about $800, $900 on this particular property for repairs and maintenance annually, $800 to $900 per unit per year for that. And then we additionally added in contract services, so landscaping, things like that, landscaping, pest control, and then also general and administrative. We factored in about 2 to 3% there. So typically we like to be, it depends on the age of the project. So this was a 1983 project. So we like to be anywhere in the range of 40 to 45% for a 1983 project. That includes real estate taxes and insurance.
Yeah, 40 to 45%. You can say almost 50% even before you get to your debt service.
Yes, just under that. Yeah, on 1980s. And we're also factoring the fact that we're renovating. So the repairs and maintenance and turnover is going to be reduced when we do that. So we felt comfortable. I think we were at 46% on our underwriting for 1980. But if you're looking at a 1920 build or a 1950 build, you're going to factor in probably closer to 45 to 55% in operating expenses.
So in terms of the actual maintenance that happens, so how do you go about the pricing? So did you negotiate the pricing with your property manager, or they came up with a rate card, or how does that work? That simple example of that toilet roll fell down, so how much is that costing? Because there's a minimum kind of a service call to even put that back. Although it's a small issue, but it needs some time or... Yeah. So for us, it is with our property management companies that we're using, it's an hourly basis, on our hourly basis. So they give us their hourly rate of what they charge. And then additionally, it's, materials on top of that. So those are the two charges. They don't charge for, fees to go out there or fees to take a call. Some property managers do, but it's, just they charge for the hourly rate and they charge for the product specifically. And if they need to make multiple trips, sometimes they charge for trip charge. But typically, it's just from the moment they leave their office, that's when the time card clocks in. But we don't handle any of that. The property manager handles all that. Yeah, they just send you the invoice. Yeah, by the unit or whatever.
Yeah, and then I'll oversee that, and I'll if I'm seeing anything that's kind of egregious, I'll go in and I'll ask the property manager, and I'm looking at those on a weekly basis to make sure that there's no significant charges that that we
Yeah,
didn't
you
know.
pass through. Yeah. And how are the rates different between your Arizona versus Kansas City? So how much are you paying in Arizona versus how much are you paying in Kansas City?
Is that overall or just maintenance?
The maintenance, the hourly
Maintenance,
rate.
yeah, hourly rates are pretty similar. Maybe a couple dollar difference in hourly rates and then just material costs, but it's very, very comparable in those two markets. Specifically, I mean, we're talking anywhere from $35 to $40 an hour on the hourly rate, and then materials on top of that.
Now that you know about real estate after doing these two deals, what mistakes you would have known before you entered into your first and then the second one as well? Although you had some learning curve from the first one, but there's some mistakes that happen.
Yeah, sure. The big one that sticks out for us is capital raising. So we raise from friends, family, network, anybody, and anybody that we've connected with. And so for the big one for us is having capital ready, or at least a good chunk of the capital ready before we get into contract. The first project and that comes with time, but the first project we did was the week before we closed, we lost $250,000 in commitments as we started to collect the checks. So the capital from start to finish, raising the capital was a big factor that we've kind of improved and are continuing to improve. I mean, it's never easy, but we've been continuing to improve as we go.
Now that's always a challenge, right? So commitment versus when it's time to actually collect the check. Let's talk about syndication here. So apart from the immediate friends and family, how did you reach out to your investors?
So a lot of it was, like I said, friends and family, like you mentioned, friends and family, and then additional their networks as well. We did a lot of reaching out to our friends and families, friends and family, and then from there we've also raised money via LinkedIn, making connections on through direct messages, through kind of our the footprint that I've built on LinkedIn, and and through social media as well. So people have seen, followed us and seen our progression and seen us do good things, and so they've reached out to us, and we've gone on phone calls, and a lot of it we're very focused on. Given for me, given the knowledge and background that I've been given from my family and my dad, having someone so close to me that I can call on at any moment to kind of be my mentor. I've wanted to share a lot of that knowledge and a lot of knowledge that I've gained over the last better part of a decade within real estate, and share that knowledge to as many people as I can. So that's a big passion of mine. It was a kind of a superpower that I was born with, that I had that, father that, and it wasn't even my superpower, but I had that father that went through all the ups and downs of real estate, and he's been able to, teach me. So I want to teach people and teach people the benefits of real estate. And so that's kind of where we started with our content and with getting into this business is providing people with this opportunity that wouldn't normally have the opportunity to have these opportunities. So how many people can say that they own an apartment building or part of an apartment building? Not too many people. So we want to make sure that we provide that opportunity to more people. So
awesome. Well, no, that's a great messaging here. Well, we'll go into the fun round here, and we'll kind of lighten up.
Sure.
So it's a quick fire round.
Yeah.
Just say whatever the first thing comes to your mind. Okay, I'm going to ask you some questions here.
Okay.
Favorite real estate or personal development book?
I've got a lot here. I would say I just read, and it's definitely my favorite, $100 Million Leads by Alex Hormozi. He had that big webinar a couple weeks ago, and it fired me up. So I read his second book, about ready to start his Money Models book.
So what is it about, $100 million leads?
It's about just getting leads for your business and how to do that, how to market to your leads, how to convert on your leads from anywhere from cold to warm to hot, and gives you the step-by-step playbook for that. So that's my favorite business book, I'd say.
One thing you wish every investor would know.
Investing is not perfect, and it's can be very beneficial. And if you're looking for, I know everybody says it, but if you're looking for that instant, I'm going to be a millionaire tomorrow, you're not going to get it. However, if you want to be wealthy long-term, planting your money and letting it grow and letting it make money for you is a great, great superpower. And in real estate, I believe is the best way to do that.
Absolutely, I agree. I mean, it's not get rich scheme here. It's a process. It's investing, but if you do it the right way, you'll make money. You'll make cash flow as well as wealth.
Yeah, and you don't need hundreds of thousands of dollars to get into real estate.
Absolutely not. I mean,
our syndications are our minimum investment is anywhere from 25 to 50 grand on a deal. So
your dream real estate market or your vacation destination?
I want to go to Europe. I want to go, I guess, to the Mediterranean. I don't know if that's I want to go to the Mediterranean.
That's beautiful, right?
Yeah. And I watch Below Deck with my wife, and Below Deck Mediterranean. I'm going to be there, and I'm going to be hanging out there quite a bit when I'm older, and that's kind of what keeps me going.
Biggest mind shift that helped you level up?
People. You don't necessarily need to know everything. You don't know everything. You won't know everything. So leveraging people and offering leverage to people so that you guys can both level up has been huge.
Absolutely. Talking to people, networking, and as you said, collaborative level up.
Yeah.
Sometimes it's giving, sometimes it's receiving, but you both level up. What does the word bigger life mean to you?
I would say for me, bigger life means, what you're doing it for, investing specifically for me, the business I'm building, what I'm doing it for. I'm doing it for my family. I'm doing it for the future generations of my family and future generations of my investors' families. And, people, even if they aren't investing with me, doesn't matter to me. If I can provide value in any way, that's what I'm doing it for. So that's what that means to me. What about you?
Well, for me, it's mind, body, soul, and finance.
Okay.
So, but although finance is the last one, but it kind of comes first, because if you don't have, and I have gone through those phases too, right? When you don't have money, then you can't think about mind, body, soul. I mean, this all seems bookish.
Sure. Right.
You're like, okay, I need to pay the rent. I need to pay the car gas. I need to bring food on the table. What are you talking about? Right. But as you graduate or as you start making income, so that's when I think that mind shift needs to happen, where that finance needs to start moving, pushing out a little bit. So that as a bigger life, from a perspective of that, your mind is the one that's controlling everything, right? A sane mind will help you have a sane body, and that sane body will help you have a sane soul. And of course, finance, we kind of pushed it out. You made your money. I mean, you have your wealth. End of the day, it's just different zeros, right, in the bank account.
Yeah.
2 or 3 zeros, less or more, is not going to make much of a difference, as long as you have what you need.
Yeah. I like
beyond that. Mm-hmm. Yeah. Well, Hayden, this is a truly valuable and inspiring conversation. I really enjoyed our discussion. How you got from property management, learning the ropes, like right from the beginning of the hula hoops to property manager, and then doing your first acquisition with 10 units and the second one. And the most, another thing that I liked about this was everything that you're doing is remote investment. Nothing is closer to you.
Yeah.
So this is awesome, man.
Yeah, I appreciate it. Yeah, it's been a great conversation. I appreciate you having me on.
So if somebody wants to reach out to you, so what's the best method to get in touch with you, Hayden, and invest with you?
Yeah, they can reach out on my LinkedIn or Instagram. It's just my first and last name, Hayden Duer, Hayden Duer. Or they can check us out on our website. It's duerurakami.com.
Awesome. And to our listeners, if you got value from this episode, please subscribe, and we'll be back next week with another episode. Thank you.